Good day, everyone. Thank you for joining. We have a really exciting topic today. It has an acronym like everything else today. It's MSR, and which is interesting because when I say that to a lot of people, they're like, "What is that?" So I hopefully today we have a real expert with us who will give us the opportunity to explain what it is, mortgage servicing rights, and why it's such a great opportunity to invest in. Um, we have Robert, who is right here. Robert has 30 years of experience in banking, investment banking, asset management, and he's really a proven entrepreneur and deal maker. He has, besides being so experienced in those areas, he's taken a couple of companies public. He
Yeah.
spent part of his career as a treasurer of two large financial institutions and has deep experience in investment management. He's also, just as a little side thing, has a CFA, which means he's obviously good at writing exams and studying, and has two sons based in Atlanta. Um, the topic we're going to cover is one that is not as well known to a lot of people. So we're really lucky to have Robert to explain it. And also, he's got his team here. They're on the call, but it's really Robert that's going to lead us today in the webinar. And if you don't mind, Robert, if you could start and just explain, tell us a little bit about yourself and your team, and also about Grander, your organization, so we get some background to learn more about what this topic is all about and how it may be something that people may want to invest in or at
Yeah.
least follow in the future to see why it's something that you're so interested and committed to and
Yeah.
invested in.
And invested in
Right.
a lot of my personal investment is in this. No, absolutely. Again, as Milton said, I spent a big portion of my career working in large, complex financial institutions, and um, as treasurer, you're like a catcher in baseball. You're involved in everything. So as treasurer, I was involved in managing a big investment portfolio as well as managing the NIM, or the earnings of the company. And when you're in a financial institution that's largely very big in the mortgage and consumer space, there's two big things you monitor. One is your mortgage portfolio, and mortgage servicing rights was a critical asset class that we managed at these two institutions, both for classic portfolio management, diversification, and earnings. And when you look at mortgage servicing rights over the course of the business cycle, it's double-digit returns. And it has so many portfolio management characteristics, cash management characteristics. It's just a preeminent asset class. Historically, it's not been available to individuals, high net worth family offices. It's been really an institutional product. It's part of the $13 trillion mortgage market. So we're talking about a massive market here with all sorts of interesting opportunities to what I think about arbitraging it. So I have a deep background in this particular asset class and have personally managed this asset class at a pretty high level. Um, and so that's my background. I want to call out a couple of other folks on our team. Dave Haas, likewise, has 30 plus years experience, a little bit like my background. But Dave was at Wells Fargo for most of his career, and his professional career spans all aspects of the mortgage business, which includes portfolio management, i.e., managing this asset class, capital markets, the servicing aspect of it. Dave was, like me, was preeminently involved in joint ventures and M&A, and building out the businesses. So he and I have been it's been very complementary. Our skills have been very complementary, and we're culturally very aligned coming out of those banking models. So if you build a relationship with us, we will spend time building a dialogue with you, and Dave Haas, our CIO, will be preeminent in that building that relationship. The other person I just want to mention is Tom McEtition. Tom has been with Grander now for 5 years. He's head of marketing investor relations. we put a lot of energy in part when we partner with somebody to make sure we are linked with them. So we have a very proactive outreach to our investors. We try to stay linked with them as thoughtful as we can, and we do that proactively. And Tom leads all of that. Likewise, he's a senior person. He's smart enough to know how to proactively partner with a family office, an individual, institutional. So he's got a great background in that. He comes out of a fixed income background and a client development background. So two very, very important people within Grander. Then if you have time, you can pull up our website. We try to have a crisp website, but part of that website will list out the rest of our team. Again, we've got a very talented, focused team, and you can pull that up. You can pull that up at your leisure to look at the full team. Milton, I think maybe now I should maybe give some context of Grander, the business, if this is a good point in time.
Yeah, if you don't mind, and also Robert, just to go back for a
Yeah,
second, right now, because this is such a trillion-dollar market, it's massive.
it's massive.
So right now, your experience has been in managing about how much in AUMs, assets
Yeah.
under management?
Oh my goodness. So if you go back to the financial institutions, the two that Dave and I work for, Wells Fargo, and the two other institutions, we were probably one, two, or three largest owners of MSR in the world. And we both had teams that were literally explicitly managing that portion of our balance sheet for years. So if you look at our historical backgrounds, we were one, two, or three the largest owners of MSR and managing it.
Wow.
At Grander right now, we're in the $4, $5, $6 billion UPB,
Okay.
maybe a little bit more. So we're not managing trillions, but we are managing billions
Mm.
at Grander. And we've created a model. It's interesting. The way I think about it is at Wells Fargo, Dave had this massive infrastructure to invest in MSR. And what we've tried to do is pull out pieces of that, guys, where we build the operating aspects of managing MSR, but we don't have the burden. We don't have the regulatory burden. We don't have the financial burden of this large public company, and we can be very, very, what I call sophisticated in managing our business model, keeping our expenses down, but being smart in terms of having the right architecture to manage it and keeping our expenses down and be very competitive in the market. So we have a very, very interesting model. Now, it's taken us, it took us almost 3 years to build it. So the reason most people won't do this is it's a pretty hard process to get through, and I'll take us through that, Milton, of what that meant. But yes,
Yeah.
we got a lot of experience in size-wise in terms of managing the asset class.
If it's okay, Robert, let me throw up that first slide,
Yeah,
and which will, talk about some of the barriers to entry, but also, if you don't mind, talk about more about Grander and, a little more background, give us more color on this.
yeah, absolutely. So Grander was formed about 6 years ago, and it was the thought process of myself and my partner. We believed that at that point in time, we were almost a decade into the recovery, and we were beginning to see some cracks in credit. We were beginning to see some excesses in the way the mortgage industry was pricing, the way the banking industry was pricing, and those are all sort of leading indicators that we're seeing some excesses. It's very difficult to tell how that's going to manifest itself in terms of an opportunity, but we saw those excesses building, and we had lived those excesses. So when you go through multiple business cycles, you begin to develop some experience in those excesses, and those excesses lead you to prepare for opportunity. So we came back and said, we want to prepare for an opportunity where we see something, a cataclysm, it's difficult to predict, in mortgage servicing rights. So what tends to happen in the banking industry or the mortgage industry when there's either a macroeconomic event, a microeconomic event, or a company just makes a bad business decision and they put themselves in harm's way. One of the asset classes they use to manage their problem is selling mortgage servicing rights. So when a bank has a problem, Silicon Valley Bank, or when a bank has a problem, and it might just be a bad management decision, they tend to then look at what do I need to sell to survive? And one of the things that tends to always have value and really an interesting asset class that chews up a lot of capital for them is mortgage servicing rights. So the first thing they sell is a beautiful asset. They want to own the asset. They love it. It turns off a lot of cash flow. It has a lot of value. They have to sell it. And so in our minds, we were trying to build a model where we could take advantage of a situation like that. So we launched with Grander, Milton, and team with the thesis that we were going to put our foot in the ground and we were going to build it brick by brick, literally brick by brick of what it took to build out Grander, put the time, the energy, and our own personal money to build it. And that's what we did. So this
And
slide of
if
barriers to
if
entry, yeah, go
just
ahead,
just
Bill.
before you jump into the barriers to entry, because I think that's going to explain a lot to people.
Yeah,
But just for people on the call, now I don't know if everyone really understands when you have a more and I'll explain it in layman's terms, and then you can correct me, Robert, because you're the
yeah,
expert. But when you have a mortgage, what happens is somebody has to do that paperwork to handle when I make my payment.
yeah.
Where does the money go? How does it get allocated to make sure that the interest is paid on the loan, the real estate escrow is handled if there
Right.
is, or insurance? So the mortgage servicing rights is that administrative process.
That's right.
So whether, as you were talking about, macro, micro events in the economy, so whether or not mortgage, we have a meltdown like 2008 and 2009, the mortgages that exist still need to be serviced, meaning this
Right.
administrative function. And what happens is the banks separate that administration function from the actual ownership of the cash that they put out. So they put out $1 million mortgage or $100,000 mortgage, but they don't necessarily want to do the servicing, all this administration work.
That's right.
So they sell that off because there's revenue, because in your mortgage calculation of how much you're paying every month is an amount to do this administration work. And
That's
that's
right.
what these mortgage servicing rights are. And here we have the expert, Robert, who's buying that administrative, we'll
Mhm.
call it pain in the butt work that the banks really either aren't set up for because they don't want the phone calls from me saying, wait a second, I made my mortgage payment, but yet it's showing on my statement that I didn't make the payment. So
Yeah,
this is where it's not, you can't just buy this and sit on it. You have to actually know how to manage it. And that's where now I hope I didn't
yeah.
take your thunder, but
No, no, no.
that
This is
then now you can talk about why it's not for everybody. Like I can't just wake up tomorrow morning and call up Bank of America and say, you know what, send me $1 billion worth of mortgages and I'll
yeah,
handle all the paperwork for you.
that's right. No, I think that's a very good. So let me put a fine point or two on it. So Milton's exactly right. So to describe the cash flow, think about your mortgage. So probably most folks on the phone have a mortgage on a home. This is your primary residence, and most of those mortgages are 30-year mortgages, right? So you get an amortization schedule. So you take a $500,000 loan out, you do it at 7%. Partial of your payment is principal and interest, but part of your payment is 25 basis points off of get whatever your loan balance is. You pay 25 basis points to service that loan. So Milton's exactly right. And Fannie and Freddie Mac are the architects of that 25 basis points. So that's an industry standard. In other words, Robert doesn't make that up. Milton doesn't make that up. That's driven by the industry standard. And you as consumers and I as consumers, part of our payment is that 25 basis points. It's a very valuable cash flow. It's an extraordinarily unique and very valuable cash flow. So as long as Robert Williams, his loan is outstanding, he makes that 25 basis point payment to the bank. That bank is selling me that 25 basis point payment. I am modeling out that 25 basis point payment. I put in a model. I model it out. How long is that payment going to be outstanding? And then I PV it back to try to get a double digit return, unlevered. And we then dig into that in great detail around trying to optimize at the loan level. Do I want Robert Williams' loan or do I want Milton's loan? Do I want Barry's loan? Do I want Tom's loan? Do I want Eric's? And we see very different characteristics of how that consumer pays off their loan. And we want that loan outstanding as long as possible because we want to earn that 25 basis points as long as possible. So one of the interesting aspects where we're right here is the risk is, so here's the big risk. Let me take you through the risk real quick. The risk is Robert Williams pays off that loan. And there's two reasons I pay off that loan. One is rates drop and I can refinance and I get a new loan. We try to protect ourselves in that through a recapture agreement. Then the other reason I pay off the loan, I decide I don't want to live in California anymore. And even though it's not economically advantageous for me to necessarily pay off the loan, I'm out of California. I want to move to Texas. That's called an uneconomic prepay, and we try to track that and recapture that. So the big risk here is it's not credit risk. It's not a lot of liquidity risk. It's not leverage, not all of that. It's that prepay risk. And we try to manage that prepay risk at a very sophisticated way at the loan level. So it was a good point, Milton, to take the team through that. So the beauty of this is the thing we are excited about is we can model that. That's cash. So I can come back to you and say, here's the portfolio. Here's how we model that 25 basis point strip. Here's our concerns around prepays. Here's how we model that. And we think it's money good on cash on cash. I love things that generate cash. I am less interested at this point, particularly in my life, of investing something for hoping we're going to IPO. So a big portion of what we're doing right now is cash on cash. And so, and we'll talk about how high net worth and family offices are using this as a cash management tool and as a diversification tool to manage their cash, their capital calls and things of that nature. So a quick,
Let me,
so that, go ahead, Emil.
yeah, so I don't want to throw you off where you're going here, but so when let's use my example, you go to Bank of America and say, I'll buy $1 billion worth of your
Yeah,
mortgage. Not that you don't buy the $1 billion worth of mortgages, you buy the servicing or administration rights.
correct.
Do you pay them the full 25 basis points up front, recognizing some people may do these things like
Mm.
move or whatever it is, but delinquent mortgage, whatever the case may be?
Yeah,
How do you know
yeah,
that what to do with that? And that's, you mentioned you have modeling, but I
yeah.
just wanted to highlight that, how you manage, I'll call that a risk in the business.
100%. So let's talk that through. So there's a number of what I call sort of secret sauces in this particular model we take it to. So you're exactly right. So we have to source that asset. So Bank of America has to know us, and Bank of America has to say, yeah, show Robert Williams and Grander a pool of MSR. So sourcing's big. So to Milton's point, the team on the phone here, we can't just go out and buy MSR. We have to be licensed. We have to have Fannie Freddie approval. There's a lot of things we have to have in order to own MSR. Then once we have all of those approvals, we got to get somebody to source MSR, sell MSR. So our team, we have relationships with 600 to 700 banks at the C-suite. We have relationships with most of the big mortgage companies. They know us through our industry relationships. We have somebody that actually keeps a relationship up with them. And we have a very different model because when Bank of America sells MSR, if they sell MSR in the market to a broker's market and they sell it to Wells Fargo, Wells Fargo now has the name of their customer because they're going to sell it to Wells Fargo. Wells Fargo is going to take that consumer and they're going to say, by the way, Robert, I don't know why you got your deposit at Bank of America. We'll pay you a point more, Robert. Move your deposit over. So a big part of our model is when Bank of America sells us their MSR, we don't steal their customer. In fact, we're the opposite. We're trying to help Bank of America retain that customer and keep that loan. So we're shoulder to shoulder with Bank of America tracking that customer. If that customer is thinking about refinancing or leaving, or they leaving, we call Bank of America and say, you got to go back and make them a new loan. You got to go back and keep that customer. We are tracking that on the servicing system day by day with them and working with them to retain that customer. It's a big part of the secret sauce.
Yeah.
Bank of America says, hey, do not sell. You might get a little bit better price with Wells Fargo or Chase, but they're gonna steal our customer. You probably need to sell that to Robert if he's in the ballpark, even if he doesn't have the best price, because I don't want to lose my customer.
Right.
So I'm willing to subservice it with them, or I'm willing to service it with one of my servicers, and I'm shoulder to shoulder, Milton, to help them retain that customer.
So you're not offering a Wells Fargo credit card to a Bank of America client. You're doing what you do, which is make really nice returns, which I know we'll see later,
Yeah,
by being kind of the good servicing intermediary for the banks and not a competitor, which is a big deal for them.
I tell the CEO, I'm a strategic partner with you. I'm an extension, actually, even more. I'm a strategic partner. I'm actually an extension of, you should think of me as an CEO, as an extension of your team, and you now have somebody else who's trying to help you retain the customer. You need to sell MSR for whatever particular reason you need. You need to sell it because you've got a concentration issue. You need to sell it because the regulator says you need to raise more capital. You need to sell it because you want to do an asset allocation. You want to do an M&A deal. You're raising capital by selling MSR that's cheaper than issuing stock. So there's all sorts of economic and non-economic reasons that Bank of America could sell that MSR. And that treasurer and CFO at Bank of America are very sophisticated, and they use MSR not only as a tool for their NIM management or earnings management, they use it as their tool on their M&A strategy in terms of raising cash to buy things.
So
Very,
they're
very,
so
very
they're
sophisticated.
so they're sitting with this pool of mortgages with
Mhm.
this 25 basis points of value that they could either do themselves,
Yeah,
or they know there are people like Robert who will come here, or Grander, that will be, potentially will come in and buy it from them. So that's liquid cash. They don't need to borrow from another bank or do anything else. They could just sell that asset. By the way, it doesn't require a big press release because it's their normal course of
100%.
business. And it's a great way to generate quick cash for those financial institutions.
100%. And it's a really good point. It's off the radar screen. They sell the MSR. No customer disruption on their side. It's low key. The regulator likes it. The regulator, meaning Fannie and Freddie, know about trade. Fannie and Freddie know us through reputation. So it's a holistic trade, and it's a complementary for everybody. And and they know that we're trying to be a good partner with them. So we are not a one-off transaction with anybody. Everything we try to do is build a long-term relationship or partnership, and that just requires a lot of patience and a culture, and that's exactly the case, Milton. 100%.
So now tell me why everyone doesn't jump into this business. I know you obviously must have spent a few dollars
Yeah.
so tell us about what are the barriers to entry? How hard is it to become a player? I mean, granted,
It is.
part of your secret sauce is also you have access, as you said, to 600 financial institutions
Yeah.
at the C-suite, not something I could wake up tomorrow morning and start calling Jamie Dimon and ask him if he'll send me some mortgage servicing rights. But tell us what's involved you know, in getting into this game, just so we could understand how, Grander has really built I'll call a moat around your business to a
Yeah,
certain
yeah, yeah.
extent.
Yeah. We could call Jamie. He would kick us right down to their treasurer, by the way. He would
Okay.
say, Robert, I don't have time to deal with it. You need to call me. So there's a couple of things. One is in order, so you're exactly right, Milton. You and I can't go out and just buy MSR. So you can go out and buy stock through your broker. You can go out and buy municipal bonds. You can buy corporate bonds through a broker. You can buy a company without regulatory approval unless it's in mortgage service in MSR, you have to have a nationally licensed mortgage company in good standing in all the states. So if I buy a mortgage servicing rights in Nevada, I have to be licensed in that state of Nevada. So you have to be a nationally licensed mortgage company in good standing. So we built that brick by brick. We went and got licenses in 46 states. We chose not to get in 4 states, and I'll explain why, but we did that brick by brick, where we applied and we became a nationally licensed mortgage company. So you have to have the wherewithal, the vision, the capital, the grind to do that. I didn't want to buy one. I didn't want any contingent liabilities. So I built that brick by brick in each state. And that's a journey. Just a physical, financial journey and time journey that a lot of people don't want to go through. We did. It took us, a couple of years to grind through that. Then, then once you have that, you have to have Fannie and Freddie have to approve you. In other words, we're buying MSR that Fannie and Freddie are essentially backing. So Fannie and Freddie's not going to let anybody just have the ability to buy that MSR. So I had to go through an extensive application process with both of those GSEs, government-sponsored enterprises, and they could turn us down. You can go through that process, and it's about a year, and it's pretty expensive, and they can turn you down. Where we were credible, they knew me and they knew Dave Haas and our team, and we had been very good stewards of the market. We've been very good stewards of the MSR world and very good stewards of mortgages. So we had some credibility with them. You can't just walk in and do this application and Fannie and Freddie approve you. So we had a little bit of a history that allowed us to do this. So we went through that. We grind through that, and that was year and a half. And you got to go through that, and it's expensive. Then we built our own independent pricing models. We tested those. That's pretty expensive and time consuming. We were patient. We went into this not having to do it. We went into this as sort of a labor of love and a labor of a vision. And we had the expertise in the background. So that took us, just to build that architecture, took us, call it 2.5 years and maybe $4 million to just grind through it and build it. And we parallel raised some capital. We were going to test the pipes, if you will. And Fannie and Freddie approved us. I mean, it was very possible they didn't. To make a fine point on this, there are people who are capable of building a nationally licensed mortgage company. There are people who are capable of building a model. You got to put together that sourcing that I just described to you. You have to put together the credibility of building that nationally licensed mortgage company, Fannie and Freddie, and building those models. There are people that can do parts of those. It's not many teams that can do all of those. Then you got to be willing to put 2 to 2.5 years of effort in it and about $3 to $4 million. And so a lot of folks won't go through that grind to get to where we are today. And
And
it's paid off dividends because now we have access to this amazing asset class in a very, very efficient model.
so, and just again, a point of clarification. So Fannie Mae and Freddie Mac, they don't actually lend the money, but they guarantee the money to banks that lend the money. So they're looking at it and they don't want to get bad news that all of a sudden that there are a whole bunch of consumers who have, $50,000 mortgages on
That's
their
right.
trailer park that are being told that they didn't properly receive the payments or whatever, because that's, they're today they're public organizations. They're government controlled, although that may change. So I know that's in the works. So they want to make sure everything is running smoothly. They don't
100%.
want any headaches. So you go out and spend a few $1 million to get all these licenses and
Yep.
sourcing, and then you got to go to the big, call it government organizations,
Yep.
Freddie Mac and Fannie Mae, and they could say, look, we don't think you're the guy that could, represent us
That's
really
right.
correctly, because you're not doing we're worried that you may do something wrong and it's going to reflect bad on us, which reflects bad on the banks, and the
Yep.
press will be all over, be front page Wall Street Journal. So,
100%.
so you have to be that, you know, squeaky clean, I'll call it,
Switzerland.
and also have the expertise to do all this. So just so
100%.
okay, just to be clear, yeah, thank you.
100%. That's a journey. That's a risk we took.
Hmm.
That's a journey. That's a risk we took. And we put our foot in the ground and we went through that. And again, to put a fine point on it for investors, so there's a couple of checks and balances here that I really like. One is if I'm investing in Grander and MSR, I have all of the states that are making sure that we're compliant, that they do independent audits on Grander. So there's a good check. So for the investors on the phone, there's a good check and balance on Grander that we're buttoned down and operating. And I embrace that check and balance. We have a compliance team. That compliance team works with all of the states. We embrace the check and balance. We want to be a part of that and transparent at the state level. Then Fannie and Freddie play a tremendous oversight role on Grander in the industry. We embrace that oversight role. We try to be proactive with Fannie and Freddie. We try to be sorely transparent. They do an independent audit a year. There's an arduous process that they go through and the states go through to make sure that your point, Milton, that we're good citizens and we're good stewards of the industry. And we embrace that. Then in the case of Grander, what we have been granted is a master services license with Fannie and Freddie. It's a big deal. So we are a master servicer for Grander, which means we don't have to operate the servicer. We don't have to make a loan. We are a master servicer, and they view us as a steward of the industry because we are playing an oversight role of the servicers. So we're part of the check and balance with Fannie. So it's a really, really elegant check and balance system in the model where I would argue our regulatory regime that we have built over 50 years, maybe longer, is very elegant. And that's what differentiates the US mortgage market from many other places. And we understand that and we embrace that. So this particular slide right here, guys, just shows you the different, so it just shows you, so we are licensed at the state level in all these states as a nationally licensed mortgage company, and we are an approved seller servicer for Fannie and Freddie in all these states. There's a few states up in the ones in that yellowish color, New York, Maine, Connecticut. We've chosen not to go into those states, not because we have anything against New York or those states. It's just an arduous process to get the license in New York. We see a lot of families moving from the Northeast, particularly New York, moving to Florida or South Carolina or Texas or Nevada. And that's why we chose not to be in New York. There's nothing personal against New York. It's really a business decision around licensing and the demographics of that particular consumer.
So just on that, Robert, so back to what you had talked about earlier, you're buying these mortgage servicing rights from a bank.
Yeah.
They're giving up that administration 25 basis point cost. But when you're figuring out in your sophisticated financial model how much you should offer to pay for it, if
Yep.
it's somebody from New York, Connecticut, New
Yeah.
Jersey, we're here. I live in South Florida.
Yeah.
So, during COVID, there were no shortage of people from those states who decided to come stay, to visit and then decided to move here permanently or at least move sell their homes up north and buy down here, which, by the way, caused our real estate prices to double. But that's a different thing.
Yeah.
But from being in the mortgage servicing rights, that would mean that servicing right would disappear. So it's easier to go into stable states like, let's call it Ohio, where less people are just going to be transient, or South Dakota, or, et cetera.
100%. And so just to again put a fine point on that, we evaluate a portfolio at the loan level. So we'll take a pool of loans from Bank of America just to illustrate the discussion, and we will look at a granular level of each loan. We don't aggregate. And so we see a very different, and by the way, we've seen a profoundly different consumer behavior pattern since COVID, profoundly different. So the sophistication of the modeling changed. So to your point, let's just make a fine point on that. So if you looked at a consumer in a good one would be New York, New Jersey, Connecticut, Illinois, we saw vastly different consumer behaviors change in those states And we saw a lot of consumers essentially moving for non-economic reasons to Florida, Georgia, South Carolina, Texas, Nevada, and it was profound. So we would price, if you ask us to look at a loan from one of those states where we seeing migration for non-economic reasons, we would either kick that out, we would kick that loan out in Connecticut, or we would price it differently. So we have a very, very detailed pricing model. On the other hand, if we see a loan in Texas, use Texas as an example, we might price that a little bit higher. We would because we see less non-economic movement in Texas. It's stable.
Mm.
Now, we also, just to give you again a sense how we think about it, take Florida. We love Florida. We love the consumer profile of Florida. What we're concerned about in Florida is hurricanes. So we look at the zip code level. We look at the zip code level in almost every state, but we really look at the zip code level in Florida even more finer point. And we try to stay away from, the coastal areas where it could get hit by a hurricane. We don't lose the cash flow, but that cash flow could get disrupted. So if Milton gets hit by a hurricane in Boca and he can't make his payment because of just mechanical reasons, even to shut down for 2 months, we are guaranteed that Fannie and Freddie, if you don't make that payment up, Fannie and Freddie will ultimately pay us or you catch us up. So that's just a timing issue. We don't lose the cash flow, but if a hurricane
Okay.
hits, we have a seasonal issue on the timing of the cash flow. And we are sensitive on the timing of that cash flow because we want our money as fast as possible. So I'm just putting a fine point on the modeling exercise here is not trivial. And I think we are preeminent in our modeling.
Cool. Nice. Nice. And um, so just as you get through this, I mean, you've got your bases covered. I'm just curious, are there a lot of people who have the status as a master servicer
No,
like Grander does?
no.
Okay.
No, and people haven't gone through it. I think we are actually almost unique.
Hmm.
You can buy, if you want to buy MSR, you can buy certain public REITs. Um, the only way you could probably invest in this asset class outside of us would be to buy one of the public REITs that's heavily invested in MSR, but they also have a credit play. So you'll see a big public REIT that has 60% of their balance sheet in MSR, 40% is some credit play, which is, by the way, I think it's a good strategy. It's just not a single asset class strategy like we have. So if you wanted to invest in MSR, I think we have a unique, very specialized opportunity to invest in the asset class. And we again have been methodical in trying to build this out and methodical and patient in terms of making investments. And we think we have a very unique model that we put a lot of energy into on the sourcing side, on the model side that we talked about, the barriers to entry, on the pricing side. And we've got a really a fund architecture to invest in this asset class as cheap as anybody we think can maybe. We don't have any explicit competition. Our
Wow.
biggest challenge is to get our thesis out and methodically align with the right investor base because we're patient. I mean, we might go, 2 or 3 quarters before we make an investment. I mean, this is not like going out and buying a stock again. We'll get a pool in from Bank of America, and we negotiate that over a 90 to 100-day process, and it could fall apart. And we're not going to get pushed into a price or set of pools that we don't like. We'll just stand down. So we need a very specific investor base that's willing to be patient with us. And if we are patient and you play the cycle, we're going to preserve capital just like we did at the financial institutions. We're going to get a good steady Eddie cash flow. We're going to get a double-digit return, and we're going to get a cash flow that we believe in modeling. It's a really good cash management tool for a family office, high net worth. It's a great investment, but it's a great cash management tool.
Could you explain that for a minute? Because you've mentioned
Yeah,
that a couple of times that it's a good cash flow management tool for, high net worths or
it
family
is.
offices. And by the way, this is great because I know a little bit about this, but I keep learning more that I talk to you. So,
Yeah.
but
Well,
so why would, if I have my family office and I want to, look for some sort of cash flow, do you pay monthly,
yeah.
quarterly? Like, why is this such a good play?
So there's a couple of ways, again, just to sort of to be illustrative here. So I have a number of family offices that we have relationships with. So a couple of examples. So I've got a handful of family offices that say, okay, Robert, um, I've got a pretty big family office. I got a big family office, and it costs me X dollars a year to run my family office. And I need to defease that. And I would like to, how much MSR would it take for me to buy to defease my cash requirements to run my family office? I'd like to just get that off my plate, not worry about it. I'd like to deploy some capital so I've got cash flow to defease my cost or expenses. So that might be one way to look at it. And that was an easy way to get involved in MSR and manage your cash needs of your family office. Then I have others that say, I'm making investments all the time. I have capital calls that sometimes come out of the blue. I'm in real estate projects that I get a black swan and I got to go in and throw some more cash in. And I would just like to build a portion of my portfolio that's steady eddy of cash that I can either reinvest back with you or I can pull it out on a quarter by quarter basis if I have unexpected capital call or unexpected thing I need, or if I see an investment I want to make. If I got one that just popped in and they needed $250,000 to make an investment in a tech startup, and so we can be that cash management tool. So I see a lot of family offices using our MSR that way, and then I have others that said I'm just tired of worried about my return. Can you give me steady 80, 10%? I mean, if you can give me steady 80, 10% and you can preserve my capital, I think I want to put a portion of my portfolio there. I just don't want to worry about. And so, Milton, I'm seeing a lot of family offices that got smoked in the real estate world or in startups, again, putting 1, 2, 3% of their allocation into MSR.
Interesting. Yeah, that makes a lot of sense to me. I mean, and how when you mentioned that Fannie Mae and Freddie Mac, they're obviously, they approved you. You're buying these MSRs from different banks.
Yeah.
Are they all Fannie Mae and Freddie Mac, or are there
100%.
they are?
100%. So
So
let me explain what that means. So it's a really interesting point. So Fannie Mae and Freddie Mac are the backbone of the U.S. mortgage market. So Fannie Mae and Freddie Mac will give their underwriting guidelines to Truist. So Fannie Mae and Freddie Mac has a set of underwriting guidelines and a criteria. And if Truist underwrites that loan to Fannie Mae and Freddie Mac standards, it's a Fannie Mae and Freddie Mac approved loan. What that means is they are guaranteeing that 25 basis points. So if there's a hurricane and there's a miss on that payment and Milton doesn't catch it up, Fannie Mae and Freddie Mac, I'll apply back to Fannie Mae and Freddie Mac and they'll top us off.
nice, nice.
So what we tell customers here, the credit risk, I guess, could be of Fannie Mae and Freddie Mac, but there's no credit risk of that home. In other words, if that consumer defaults on that loan, Fannie Mae and Freddie Mac has to take that over. We lose our cash flow from that point forward if they default,
Right,
but we're not losing a $500,000 house. We're losing our little 25 basis points spread on one loan. So it's
right,
not the end of the world. And by the way, most of the loans now that are Fannie Mae and Freddie Mac have a 75 LTV and the value of the homes come up. So that we are seeing no defaults. We're seeing no defaults because the consumer has so much equity built up in their house that if they get into a problem, meaning they lose their job or they get some kind of health crisis and they can't make the payment, they just sell the house.
right.
We really are seeing, it's really fascinating. We're seeing it's been a complete fruit basket turnover of the '08 cycle, and it's been a complete fruit basket turnover after COVID. And we are taking advantage of that fruit basket turnover in terms of what I'd call optimizing pools from Bank of America to create a steady eddy cash flow and
So if
modeling that way ahead of the market.
So if somebody sells their house,
Mhm.
and then the mortgage gets paid back.
Yep.
Say you bought a 30-year servicing right.
Yep.
Is that a bad thing for you? A
That's a
good
bad,
thing?
so that is a
Yeah.
bad thing. So let's
Okay.
walk through that. So the bad thing, that's a bad thing. So let's take the team through the bad things. We always want to know the bad things. So what we're buying, as long as that consumer is in that mortgage and makes that payment, we get that payment. So what we don't want is Milton or Robert to pay off that loan. So when they pay off that loan, we lose our MSR
If they pay it off early.
if they pay it off early.
Right.
What we negotiate with the servicer is if they pay it off early, we know about it. So we're tracking that. And if we see Milton, it's actually sophisticated. If we see Milton Googling and you live in Connecticut, Florida real estate. So we pick up the phone and say, you better call Milton because I think he's thinking about moving.
Uh,
And if he moves, you need to make him a loan in Florida. So Bank of America, pick up the phone, call Milton, say, hey, Milton, you thinking about moving? What's going on in your life? So we try to get ahead of that. We have a contract that says if Milton pays off his loan in Connecticut and moves to Florida, we want Bank of America to make you that loan. We get the MSR back for free. We don't lose it.
oh, wow.
Yeah, 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 yeah. So we've negotiated very sophisticated sub-servicing contracts, and
Oh,
we are
okay.
tracking. We have our own system. This is a big part of the secret sauce. So we have our own technology that syncs into Bank of America's servicing system, and for our loans, we track them shoulder to shoulder with them.
Wow.
We're trying to help Bank of America make sure they make the loan to you in Florida, or we are really upset. In fact, I'll make the phone call to the person and say, "Why did you not make Milton a loan?"
Yeah.
And we get that back. So that's called recapture. So
Okay.
we try to manage that so we don't lose our MSR, even in the event that Milton leaves. So it's a very sophisticated. Now, we're not always 100% successful, right? You might move down to Florida and say, I'm paying my whole loan off. I'm not buying a new house. I'm so I'm seeing a lot of people that move from Connecticut, New Jersey, Illinois, Maine. They're just paying cash.
Hmm.
They're just selling their house in New York for 10 million bucks, and they're buying a $5 million house in Florida, and they're moving on down the road. That one we can't solve.
Okay. But when you're buying the mortgage servicing rights from the banks, your formula is taking into account the fact that people may pay off early, right?
100%.
Yeah.
So we model that 100%. So the key models in the model are when will that consumer pay it off? We model a base case
Hmm.
based on the weighted. So let's use an example. So if we buy a package of loans where the mortgage servicing rights is off of a weighted average coupon of 4%, meaning the consumer has a 4% loan with Bank of America. And rates right now are at 6%, 6.5%. There's no economic reason for
They would.
that pool of MSR to prepay that loan economically because they're at 4% and the market's at 6.5%. So rates would have to drop below 4% before we saw an economic prepay.
Right.
Then you have circumstances where the consumer pays, the loan gets paid off for non-economic reasons, i.e. Milton wants to move to Florida, i.e. Milton loses a job, i.e. Milton dies, i.e. Milton goes through a divorce. So there's a whole host of uneconomic reasons, and therefore we model a certain payment, even though it's uneconomically says we'll never pay that loan off.
Right.
Then we do modeling around that we do modeling around that base case to look at a range of outcomes we would get on an unlevered basis. So we take that cash flow, we sophisticatedly model that in our model with what guardrails, goalpost, and we try to PV that back on a non-levered basis to get us somewhere between 10 and 15% unlevered return net.
Got it. Oh, geez. There may be an opening at the Fed you may want to apply because they need that type of modeling to decide where the economy is going. Because that's kind of you're like a leading indicator.
We do. We do.
You are. You are. You're a leading in. I did my
100%.
master's in my MBA in international economics, and you're like a leading indicator where the market's going.
100%. When I was treasurer
Mhm.
of a large national bank, we were in we were in 37 states, and I promise you, we saw trends that were very obvious by having a snapshot of consumer at the regional level, having a snapshot at the consumer at the national level. We were actually saw at the regional level and national level, for example, HPA. And so we could use sophisticated modeling techniques to really conclude consumer behavior around HPA and unemployment. If you can model HPA and unemployment, you can really model credit risk. You can really
What's HPA?
house price appreciation.
Oh, okay, okay. Thank
Yeah,
you.
so there's a very sophisticated aspect of having a grander type model where we are so you look at this map.
Yeah,
So we have, I believe we have MSR in pretty much all of these states. And so we look at it. We look at what happens in Nebraska, for example. So that consumer behavior in Nebraska is very different than Colorado. It's very different in Texas. And we have the ability to look at that. And you do see consumer trends. We're already seeing very different consumer trends at the state level, at the zip code level than we saw 2 years ago. I mean, COVID was a game changer in terms of being sophisticated modeling to arbitrage. And we've been able to take advantage of that. I think that trend, to your point, Milton, is going to continue. I know the
oh,
Fed really well.
yeah,
The Fed, I don't want to go off on a tangent. The Fed has the talent to do this. The Fed is just like, it's not personal. The Fed just gets caught up in a bureaucratic world. It's just so hard to change that bureaucratic world to get back down to an entrepreneurial place where you make a common sense approach because we end up in this bureaucracy that doesn't allow us to be common sense driven.
right.
We are. We are common sense driven on the facts.
Okay. And I know, excuse me, I know you wanted to tell us about your investment process, but just because I'm worried we're going to run out of time, we have a hard stop in seven
Yeah.
minutes.
Yeah.
That, if you could talk about, what sort of rates of return do people typically make? I know you mentioned the 10 to 15%, but just dive into that. And then
Yeah.
also, like, you know, how much do people typically put into something? I know
Yeah.
you talked about portfolio allocation, but is there like typically a minimum investment of 100,000, a million? Like how do people even invest in this?
Yeah.
I know they could invest obviously with Grander. You
Yeah.
would be, and you mentioned the REITs as another way to invest. So if you could
Yeah.
talk to both of those,
Yeah.
that'd be great.
Yeah. Yeah. So what we thought on this slide was to tell you that we are very process driven. So I grew up in a button down culture. So I went through formal training with a large regional bank and we were buttoned down. We were very buttoned down in terms of process and procedure. So we are very process oriented in our process of investing MSR. So this just gives you the outline that we follow in our process. So key is sourcing, calling Bank of America, getting the pool, analyzing the pools. We analyze lots of pools, and we're trying to optimize that pool. So you have to have the ability to source it. We have a team that does nothing but focus on sourcing. It's like collecting antiques. If you are collecting antiques, you want to know who has the biggest collection of silver in the world. You better know the top five, and you want to know them, and you want to buy that antique directly from those top five. We do the same thing in sourcing. We're buying antiques just like MSR like antiques. So sourcing's key. We have C-suite relationships. Then we go through an extensive due diligence on that particular pool of assets that Bank of America wants to send us. We look at it at the loan level. We kick through it in a very detailed way. We kick out certain things. We think about pricing it at different, like we just described, at the different state levels. We do it at the zip code level. Then we run that tape. Once we do that due diligence, we run that tape through our independent model and we create goalposts within our independent model of what returns we think we're going to get under different prepayment scenarios. And we create a goalpost that leads us to an ultimate price. So we iterate that as a team. It's not trivial. We iterate that back and forth over a several week process. Then there's a compliance aspect to it. Are the loans we're buying in fully compliant? We do checks and balances all around all of that particularly important element. So not trivial because we want to make sure all of that's buttoned down. We don't want to buy a loan that's not compliant. Then we subservice that to a third party. We'll do it back to Bank of America. We'll do it to a third party. So we negotiate that contract. We've got that contract in place, but we negotiate that contract. Those are favorable to us. For example, we get float when Milton and Robert make their payment for escrow balances. We get the float on that. It's a really nice kicker on our return. And so we have a team that does nothing but monitor Bank of America's subservicer that's tracking that loan for us. We're shoulder to shoulder with us. And our system, technology system syncs right into their subservicing system. I
That's
don't think
amazing.
anybody else in the world could get that done. Then we negotiate very detailed recapture contracts. Those are in place. We're trying to I call it picking up nickels. It's probably picking up $100 bills. So we're doing that on float and things of that nature in those contracts. Then we have daily monitoring of that portfolio at the loan level. So we have a team that tracks that and says, what is Robert and Milton doing every day to make sure that Robert and Milton will go get us that 25 basis points. We're explicitly grinding on that. Then, for the sake of independence, we have an independent third party that prices the portfolio. I'm mentioning to that because we embrace the system, we embrace the independence of the system. We report out to our investors quarterly. We give investors a quarterly statement. You get a quarterly distribution of income.
Oh,
We sit down with our
so that's
investors.
good cash flow. You get a quarterly payout, which is nice.
And the investor can take it out. You can pull your cash flow out. You can leave it in. We'll roll it into a new MSR investment. You can pull some out. So we'll work with you on cash flow. I had one yesterday call me even yesterday and says, "Look, my wife wants to buy a beach house. I need you to start sending me my cash flow." I said, "No problem." So we have reports that we go over with investors. We'll allocate a team member to each investor. That investor has somebody who can pick up the phone and they can get 24/7. You don't get a recording, you get a human being, and you have a backup. Then quarterly, we prefer to meet with investors. We can do it Zoom, Teams. We'll come to your office. You can come to our office. But we try to insist on meeting at least quarterly with investors, even if it's nothing to walk you through the statement to make sure you're up to speed, make sure we do a mind share check-in. So we try to do that quarterly. And then we have a lot of oversight. We're monitoring that subservicer. We have to deal with independent audits with Fannie and Freddie. Our outside accounting firm and auditor for tax and everything is Crow. Again, just trying to tell you we're buttoned down. We have a mechanical process on dealing with all of that every day, week, or month. And then finally, if we want to use leverage, this is an asset we can put leverage on. We're not a huge fan of leverage. We're not a huge fan of that risk. There's probably a smart way to use leverage. We understand that, but we tend to not like to use leverage. We can and we will, and we have all of those financing facilities in place. And by the way, you have to have Fannie and Freddie have to approve your real leverage facility. So we've gone through that. We do have leverage in place, and so that's our mechanical process. Uh,
Wonderful.
the
I'm
question you
gonna
have, yeah,
just because we're gonna run out of time, Robert.
yeah,
And this has been tremendously educational for me. I certainly got a better handle on this, and hopefully for the people attending. Um, I want to thank you for taking the time to explain this really unique industry and how congratulations on all your hard work to really become one of the premier players in this
yeah,
market. And just if you don't mind, we have a couple of minutes. For people on the webinar today, we're going to be happy where Grander or Robert would be happy to share with you a copy of this video, if you want to get back into it and understand it better or get to learn more how Grander works, they'd be happy to talk to you about it. As well, Robert, if you don't mind, if you could take a minute or so while we're just going over 1 or 2 minutes and just do a quick
yeah.
closing statement, I appreciate it.
Yeah, a couple things. That's exactly right. So again, I just want to emphasize we're relationship oriented. If you're interested in this, we would walk through, we would send you the PPM. We would send you a subscription agreement. So this is an investment in private fund. We can do $250,000. I mean, I have gone down to 100,000. High net worth and family offices, we see a 1, 2, 3% allocation. So if you're a $100 million family office, you maybe put $1 million into this in some incremental way. We see family offices approaching it that way. It's an easy process to take you through the PPM. We have a team that helps you fill out subscription agreement, and it's easy for us to build a relationship with you. Either we'll invite you. We have offices in Los Angeles, Atlanta, we have New York, and Florida. I go to Texas quite a bit, so it's easier for us to meet you. And then in closing, Milton, I just want to thank you and Barry. It's been a delightful relationship with you. We're grateful for you and Barry and your teams. Your team and Barry's team has been spectacular. So we really appreciate that partnership.
Thank you.
Um, we would be happy to, again, visit with anybody, follow up any way possible. We will take ample time to make sure you understand the investment. We view this as not a trade, but a partnership, and happy to follow up.
You sure do. Thank you, Robert, so much again, and thank everyone for attending.
Yep.
Appreciate it, and everyone have a wonderful rest of the day. Bye
Thank
bye.
you.